Hello and welcome to Market Domination. I'm Josh Lipton alongside Alexandra Canal, live from our NYC headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
We're really looking at a 50 to 70 cent drag on EPS now that they're actually accounting for the treatment of that OpenAI investment. We didn't have that in our numbers before. We're now lowering estimates because we're accounting for OpenAI, and I think that's kind of the big change here. Yes, the Azure business is slowing, but that's largely because of limited supply and capacity at this point. That will change, and you'll see a re-acceleration in Azure in the second half of their fiscal year.
A high-flying stock like Meta, you need much more high-flying numbers than what they reported yesterday. There's going to be an air pocket in Facebook shares. Nothing broken. If you're patient, if you want to look into March, April, May of next year, I think today is the time to buy Facebook shares.
You have to call it a landing at all. It's probably somewhere between soft and no landing. I don't think it really is cleanly characterized as either one. But it just suggests to me that we should be able to see continued growth along. I'm not sure we can necessarily repeat what we saw in Q3, but the consumer is still in very good shape, and I think that we'll see decent spending support growth in Q4 and into 2025 as well.
We've got 1 hour to go until the market close, and happy Halloween, Josh, because it is scary out there on Wall Street. You're seeing declines across the board. The Nasdaq Composite down about 2.5%. The benchmark S&P 500 down 1.5%, and the Dow Jones off about 0.5%. Now, if we take a look under the hood of the Nasdaq Composite, you'll see that the losses are being driven down by Microsoft. It's extended into other areas of tech like NVIDIA, Meta as well. We heard from both Microsoft and Meta after the bell yesterday, and really the guidance is what disappointed there, along with heavy capex spending, as a lot of these players are spending on AI, and there's just been such a high bar for investors as well. And we're seeing that really percolate throughout the rest of these big names. Of course, we're going to be hearing from Apple and Amazon after the bell today, but an ugly setup into those results.
Yeah, I think you point out the right pressure points, Ali. I mean, Meta and Microsoft, they clearly underwhelmed. Investors were disappointed in these results. You can see the pressure in today's trade. Maybe also bringing up kind of a broader question mark about that AI trade, or investors kind of question maybe with renewed attention all that massive AI spending that's been going on, asking where the returns are. I think NVIDIA is really interesting too, just broadly the SMH, the ETF that tracks the chips, under some pressure today.
Yeah, Broadcom as well, down about 4.3%. Now, I want to take a quick look at the VIX, otherwise known as the fear gauge on Wall Street, as we're seeing some of this sell-off in tech. We're seeing that tick higher a bit, but if we zoom out and look at a 6-month, we're nowhere near that peak we saw in early August after that weak July jobs report spooked markets. We're seeing a little bit of upward momentum in the 10-year Treasury yield, hovering around that 4.3% mark. Some strategists that I've been speaking with has said that the 4.5%, that's the next technical level to watch. So just something to keep an eye on as we continue to get these earnings results and see how that trickles through into other areas of the market.
We have smart market strategists to help us think through it. But before that, we've got a big earnings day on tap. For more on what to expect from the latest Mag 7 earnings results, let's welcome in now Yahoo Finance's Dan Howley and Josh Schaefer. Dan, what are you watching from Apple this afternoon? Walk us through it.
Yeah, the big to-do with Apple obviously is going to be iPhone sales numbers. That's going to be the key indicator, I think, I know that every investor and analyst is going to be watching, as it is every quarter. I think what has to happen here for Apple is they have to at least talk about some uptick that they've seen in iPhone 16 sales related to interest in Apple Intelligence. At the very least, Apple Intelligence was only released on Monday, but they've been advertising it for the iPhone 16 since that device launched. And so you would think that as a result, customers would go out and say, well, I want to get my hands on this big AI thing. I might as well go and get an iPhone 16, upgrade from that 13 or 14 or even 12 that I might have. That's going to be the key for Apple in this quarter. Now, we're obviously not going to get much as far as iPhone 16 sales go. We only get a sliver of time for 16 sales in the quarter to come out as part of the report. So it's not going to really provide a broader indication as to how it'll sell throughout the rest of the year. I think that's also something to keep in mind when we talk about this Apple Intelligence. This is a different thing than what we've seen with Apple in a long time, where usually when you have a new iPhone, it's bam, all the features are right there. They're not. This is going to roll out through the rest of 2024 and 2025. So you have to think at some point, there's got to be this kind of tipping point where there's enough features out there, people are excited, and then you start to see iPhone sales crank up. If they don't in this quarter or Q1, that's the holiday quarter that we're going to see next. So I think that's a lot to keep in mind because, like I said, this is a very different kind of buildup that we've seen than we've seen from Apple in the past when it comes to this particular feature. It is the go-to for this phone. It's not, camera, screen, anything. It's the software, and that software is still being rolled out.
Go ahead, Ali.
Well, Dan, I wanted to ask about, the expectation heading into the holiday season, right? Because even if we don't see that growth in iPhone demand for the third quarter, our expectation is going to be even more elevated that we'll see that in the fourth quarter as we approach the holidays.
Yeah, I think that's the key there, that it's going to be, the fourth quarter when the general consumers around the world really start to scoop up iPhones. Don't forget Macs and iPads. Those also got a nice update. But yeah, the holiday quarter is going to be a big deal for the iPhones. And I think around that time is when they'll launch that next kind of tranche of AI features. That's what they've talked about. It's in a developer beta right now with ChatGPT for Siri. Apple Visual Intelligence, that's where you can use the camera to kind of scan something and get more information about it. Those are the types of features that I think people were expecting with the first bit of Apple Intelligence capabilities. So those are the ones that if people get excited about AI, if this is something that really is going to move hardware, then those are going to be the first few features that really do it. And so if they come out in the December timeframe, just before, in the middle really of the holiday shopping season, then that could start to goose numbers for sales. So I think once those capabilities are out, that's when investors and analysts are going to say, okay, this is either doing something or it's not. This is just a little bit of what Apple's kind of given us, just a taste of what Apple Intelligence is supposed to do. Those two features, the Visual Intelligence and the ChatGPT integration, are really what people were excited about when they announced it in June. So that around the holiday season, like you said, is going to prove truly important if they hit the market at that point to see if they start to juice sales.
All right, a lot to look out for in that report. Dan Howley, thank you so much. Another company we're keeping our eyes on is Amazon, set to report third quarter earnings in just about an hour. Josh Schaefer joins us now with what to watch. And Josh, there are so many components to this business. Obviously, AWS is a big one, but also a pulse check on the consumer, right? Because that could be a risk if we see any softening there.
Yeah, so there'll be both of those aspects to it, right? We know AWS, the cloud services part of Amazon's business, has been kind of a key mover of this stock on a lot of earnings days going back over the last couple of years. So that's going to be a key area to watch. AWS revenue expected to come in at $27.49 billion, up from $23 last year. Amazon, of course, expected to grow revenue from last year, grow earnings per share, grow AWS revenue, grow ad revenue. So overall, you're seeing growth in all of those metrics. But guys, a couple things that I think are going to be rather important here. Of course, guidance, right? Guidance comes out normally with Amazon's release, so we should get that right after 4, and that will probably start moving the stock. You rewind to last quarter, Amazon's sales guidance actually disappointed the street. That was kind of what really drove the stock overall. Other things I would highlight here, one, the AI story, right? Just look at the way tech stocks are moving today. There seems to be concern again over how much these companies are spending on AI. If it's going to come back into the business, that will probably be more of a earnings call commentary story rather than something we're going to get with the release. But that's going to be a key thing to watch. And then Ali, to your point on the consumer, Amazon's online stores is still the largest part of the business, right? They're doing, last quarter they did $55 billion out of their $150 billion just in online stores alone. And so when they talk about that current quarter that they're in right now that started at the beginning of October, that's some Prime Days included. You're talking about holiday sales, right? So you get an overall read on perhaps the consumer from essentially America's largest e-commerce retailer going into the holiday quarter.
All right, Joshua, thank you. We'll be watching. Moving on, stocks under pressure with tech stocks leading the declines in today's trade as investors weigh earnings and economic data. Joining us now is Michael Aroni, State Street Global Advisors Chief Investment Strategist. Michael, it's good to see you. Let's start with those big tech names, Michael. You saw Meta and Microsoft. They report, they clearly underwhelmed. We see both those names well in the red today. I'm just wondering, Michael, do you think that is that a sign perhaps of the AI trade losing some steam here?
So I think we got a glimpse of this, Josh, in the last quarter. So what's been happening is that these companies continue to beat on top and bottom line, yet their forecasts just aren't good enough given how far they've come from a price performance perspective and where their valuations are. So I do expect this to continue to unfold given some of the risks. Now, I think this goes hand in hand with how interest rates are moving, and we know that they've been ticking up. So when interest rates are falling, particularly real interest rates, we do get a broadening, a healthy broadening in the rally. But that's been a little bit absent here this month as rates have kind of risen and not fallen. So we're going to need rates to fall a little bit to see an improvement on breadth and get us some relief from some of the disappointment in the tech earnings.
So given that, Michael, since we don't know where rates are going to be heading in the future, they could hover higher for longer, along with the fact that we're seeing this sell-off today. Is tech still a safe investment in your view?
I think it's a safe investment. Certainly, this is where the earnings growth has been. So from my perspective, these companies still compound cash flow at more than 20%. Given their size and scope, that's amazing. They have great businesses, pristine balance sheets, low debt to equity. These are companies you want to own. The real question is where do you want to add? And from my perspective, we continue to encourage folks to think beyond the mega cap stocks, beyond just the Mag 7, particularly as we anticipate that the earnings growth gap between technology and the Mag 7 and everything else will narrow. And as it narrows, we think there are better opportunities in places like financials, for example.
Beyond financials, Michael, I see also communication services, energy. Why those sectors?
So communication services, Josh, is interesting in that unlike the tech pure play sector from that perspective, here it's not as expensive. So given the earnings growth rate expectations for communication services and where they're trading from a price to earnings multiple, you're getting some good value there. And you're still getting solid earnings growth. So that's really attracting us to that sector. In terms of energy, it's certainly inexpensive from that standpoint. They return a lot of capital to shareholders through either buybacks or dividends, and yet they're inexpensive. They've shown good capital discipline. And we do believe that if you see some price improvement in oil, that ultimately these companies will remain pretty profitable. So that's more of a cyclical value play, where communication services was more of an earnings growth momentum kind of opportunity.
Michael, a little thing is happening next week, the election. What type of volatility do you expect in the short term? And are there any defensive moves that you can make no matter who is in the White House?
So it's been interesting. I've been joking that it's triple E is ultimately going to drive short-term market volatility. And we've been talking about a few of those things. Earnings overwhelmingly number one, Microsoft and Meta today. You're going to get Apple and Amazon, as you were just highlighting before this segment. You get the economic data. We're getting the jobs report tomorrow. It's going to continue to support the soft landing. And then ultimately, as you point out, the election. That's going to drive short-term volatility. I think from my perspective, those hedges, there's nothing that investors should do in reaction to the election outcome. In fact, that's often the wrong thing. But you have in a diversified portfolio some things that hedge you against risk, whether it's long-term treasuries, gold, cash. And I would just say that having those in a diversified portfolio should help in case we get unexpected or unwanted volatility post the election next week.
So are you suggesting then, Michael, if you're an investor, if you're a long-term investor and you're watching this right now, your smart move is to actually look through that election?
Absolutely, Josh. So you cannot prove statistically that any one combination, White House, Senate, House of Representatives, in terms of Democrat, 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 Republican, 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 is statistically better than any other kind of subset of government from that standpoint. As an example, annualized stock market returns under the first Trump administration, a little more than 13%. Annualized returns under the Biden administration, more than 11%. You could argue, okay, Trump was a little bit better, but Josh, over long periods of time, it's really hard to suggest that kind of who's in the White House or the makeup of Congress is going to determine your financial well-being. It's going to be other things. So we are really encouraging folks to be passionate about the election, passionate about their candidate, their party, and the issues. Go to the polls, vote, get educated, do all that. But when it comes to your portfolio, be objective, be logical, and be disciplined. We think that that's the right approach.
And besides the election, we also have the Fed meeting, right? The election seems to be overshadowing that. I heard you say that you're in the soft landing camp, but we did get really strong GDP numbers, PCE in line with expectations, still elevated. It feels to me like we're nearing closer to a no landing. So given all of these data points, what should the Fed do next week? Should they be cutting by more than 25?
I think the Fed's locked into 25 basis points next week. I think they're likely locked into 25 basis points at the December meeting. And I think that they're just acknowledging that at current target Fed funds rates, they're well above inflation. So we got PCE data today. It continues to suggest that top line headline numbers are close to that 2% target. Certainly the core numbers, ex food and energy, are a little bit elevated, but where they are from a Fed funds perspective remains too restrictive. I think a nice conservative kind of approach to cutting rates 25 basis points at a time makes the most sense. And I think that's what the Fed will deliver next week and in December.
Michael, always great to see you and have you on the show. Thanks for joining us.
Thanks, Josh.
We are just getting started here on market domination, and coming up, a big earnings day on tap. After the closing bell, we will be getting you the latest results from Apple, Amazon, and Intel. Stick around. Much more market domination still to come.
Meta reporting a beat on the top and bottom lines for the third quarter. Despite having a solid quarter, though, the stock has been falling, and it might be because investors are getting tired of all the spending. From where we're bringing in Brent Tills, senior analyst at Jefferies. And Brent, like we said, capex seems to be the catalyst for why shares are moving to the downside here. But these hyperscalers, they're not going to stop spending on AI, right? So as an investor, how do you assess how much is too much? Is it spending relative to revenues, spending relative to free cash flow? What are you looking at there?
Yeah, I think just tech is down today, not necessarily on the results, but it's on the clearing of the deck ahead of next week. Number of big macro things that are going on with the election and the Fed meeting. So what we're seeing on our desk is not necessarily fear of Microsoft or not a massive miss. It's more a broader issue that's going on. So just set the stage. But you're right on capex. That is the central focus. But I think when you start to see the type of returns we're seeing in all the hyperscalers, if you look at the capex invested to their backlog or bookings, they're equal, if not bigger, on the booking number. So that means more business is coming in than they're spending. When you start to look at some of the AI numbers now, you can start to measure like real revenue, right? Microsoft said $10 billion of revenue, fastest business to $10 billion in the company's history. We're early in the innings of this. So I think investors got to step back. It is the number one question. You're asking the right question. But I do think that there are effectively proxies and past history statements that elements that have shown that when Microsoft spent on Azure, was that a good return? When they spent on the server business, was that a good return? And even when Zuckerberg, 5-6 years ago, was in Congress, and they came out a couple years after and said, "Hey, we're going to spend," that was the right thing to do and spend, and the stock is higher. So I think we use historic context. We use kind of current frameworks. We're seeing already all these hyperscaler backlogs. The growth rates and the cumulative revenue exceed that of the AI capex investments. Now, not all these investments are broken on AI, but we've looked at it a lot of different ways. And also, like, you have NVIDIA and Microsoft at 30 times earnings. They're not 30 times revenue like Palantir. That's unsustainable. Okay, these are multiples that aren't crazy. So again, for Meta, you can get $30 of earnings power, put a 25 multiple on it, and have a way higher stock price from here.
And
so I understand.
Go ahead, Brent. Sorry.
We think we have a good answer of what's happening.
And Brent, so for Meta specifically, how is AI already impacting the business? Walk us through what's already showing up.
Well, it's showing up for you as an end user. So there are 3 billion people that come to the platform every day, and AI is helping us as consumers find the appropriate content, understand what's relevant. Perhaps we're interested in skiing or golf, or we're interested in baseball, and understanding, how that can gear the right content towards us. And then also tying, big thing for me is commerce. Like I buy half my wardrobe off of Instagram. And so, if you're Grayson, which is a great, clothing brand targeted towards golfers, like Grayson, knows who I am. Like they on Instagram are targeting me all the time. And so I'm constantly buying new things probably I don't need. And it's because they're so targeted in their approach with their ads. And so I just go back to, for consumers, you're going to have better content, you're going to have better commerce experiences, you're going to have better overall experiences. For the advertisers, the small businesses that are on the platform, it makes it easier for them to create a campaign. So if you're an interior designer and you own a small store like my wife does in San Francisco, she can create a campaign for a sidewalk sale. We're having a sale on couches, blankets, pillows. And oh, by the way, instead of hiring someone to do a photo shoot and bring a bunch of new photos and videos and music and everything, you hit the button and you upload all the pictures from last year's sidewalk sale, and it'll basically create the campaign for you at a fraction of that human being you'd have to hire to shoot the shoot to drive the advertising campaign. So, I mean, there's already examples of this already working, and they've said this in terms of the Meta AI having an uplift in terms of time spent, Meta AI having an uplift in terms of transactions and ROI for advertisers. I could go on for hours about the experiences that people are having. But again, that's why you're seeing 20% revenue growth. That's why you see a 40% margin. And overall, again, I think the spending is working, and I understand the fear. But again, it's a fear across everyone, not just for Meta.
So Brent, when we zoom out and look across the board for all these tech companies besides just Meta, I keep hearing how the AI revolution is a generational opportunity. Which companies are best positioned to take advantage of that opportunity? And is it a situation where you should be owning all of them, or should you be a little bit more selective?
Our thesis on AI is threefold. You need users, data, and capital. And the only companies you can count on one hand how many companies have that opportunity. Right? And if you think about it, it's Microsoft, Amazon in enterprise, Meta and Google in consumer. You have NVIDIA, who's creating the next generation on obviously the infrastructure and chip side. You have just a couple networking companies that have solved this, like ANET, Arista Networks. You have, there's only a few companies that have this dialed in. And all you have to do is look at some of the results, whether ASML, AMD, look at who doesn't have the next generation, and you're looking at what's happening to those stocks. Again, we think that the list is shorter. There are going to be opportunities for new vendors. Obviously, OpenAI in the private market. You look at, I've said this repeatedly. I use Perplexity every day. I'm addicted. My wife says put it down. I use Perplexity every day to solve answers. You think about there's going to be other great private stories that come up, but the list is short because each one of those has to have users, data, and capital. And this is not a game for vendors that have a few dollars. Like, this is $1 billion game, and you see it with Meta, Microsoft, Amazon. I mean, Microsoft and Amazon are going to spend $80 billion in capex next year, 80. So $160 billion between the two. Not many companies can keep up with that.
Brent, always good to have you on the show. Thanks for joining us.
Thanks.
Microsoft's first quarter earnings beating Wall Street's expectations on cloud strength. However, the picture for its cloud growth in the second quarter is spooking some investors. Microsoft still continues to work towards meeting Azure demand as it lifts capex spending. Jackson Ader, KeyBank Capital Markets Managing Director and Equity Research Analyst, joins us now for more on Microsoft. Jackson, it's good to see you. So Microsoft reports investors, at least initially here, they seem underwhelmed, Jackson. Below consensus Q2 guidance seems to be part of the issue, but walk us through what you made of the print.
Sure, yeah. Thanks for having me, Josh. Yeah, it's not just investors that were underwhelmed. I was underwhelmed as well. Sell side estimates were underwhelmed by the outlook for Azure growth next quarter. I'm fond of saying that Azure growth is the number 1, number 2, and number 3 most important metric for this company, even a $3 trillion company. So second quarter Azure revenue growth is expected to be 31 to 32% on constant currency. That seems fine, except people were expecting 33, 34, even 35, as we hope to see some acceleration as we go through the rest of their fiscal 25. It's explainable. At least we have that backdrop. The company said that there was some one-time revenue in the first quarter that won't repeat in the second quarter. And then importantly, it's the capacity constraints. They simply cannot keep up with the demand. And data centers that they thought were going to be able to come online in the second quarter are being pushed out to the third and fourth quarter. And so you just have this revenue trapped, waiting for the capacity to catch up.
So Jackson, to that point, like you said, Microsoft has consistently said that demand is so strong. So could the weakness that we're seeing in shares be a potential buying opportunity?
We do think it's a buying opportunity. We're sticking with our long-term thesis. I mean, there are so many different megatrends that you can play with Microsoft. If you want to get exposure to artificial intelligence, great. Brent just mentioned it. $10 billion run rate on AI revenue, and you get it from Azure and you get it from Copilot, whether it's security, GitHub, Microsoft Copilot, and the rest. If you want to play the longer scope of just movement to the cloud, changing workloads from on-premise to the cloud. Great. They've got a $50 billion Azure business that has nothing to do with artificial intelligence, just your regular way movement to the cloud. If you want to play the mega trend of consolidating software vendors, meaning platforms are going to continue to beat point solutions and products, wonderful. Microsoft is the broadest and the deepest software platform in existence. So it's a great place to play any number of megatrends. That's why we continue to like it. And the fear really today is about, okay, that revenue that is sitting on the sideline, is it possible that it might go to another hyperscaler? Is it possible that it might find its way to Oracle with OCI or Google Cloud or Amazon? Our feeling is that if Microsoft is having a hard time getting data centers online at the last moment, probably related to the kits, the chips, the servers, then we would be surprised if other hyperscalers weren't also seeing that same problem. It's not as if other hyperscalers are going to say, oh, Microsoft has a capacity issue, but we've just got loads of capacity over here. Come on over.
Jackson, at the same time, lots of focus on that capex spend and return on that spend. You heard us talking to Brent in the last segment about that. When you were talking to your clients about the print, were they bringing that up? And if so, what were you telling them?
Not as much as you would think. The comment that really dominated the night was Azure Outlook, but people certainly look at the capex number. It was broadly in line with what the company had said, and most had expected capex to increase through the year. And so the sequential expectation for increase in capex certainly was within the realm of investor expectations. But it's a good point. If you look at this company, sometimes I'm guilty of getting into the software silo and trying to value everything on enterprise value to free cash flow or unlevered free cash flow. And as I've had some more conversations of late with broader technology investors that look certainly in software, but also in other spaces, there's a penchant to value this company not necessarily on forward free cash flow, but on an EPS basis, where you can smooth out the immediate capex investment over a few years through a depreciation schedule that better matches with the revenue that is expected from these AI investments that are being made right now. And I'll reference Brent again. What a sharp guy. 30 times forward GAAP EPS is not expensive for Microsoft.
So when we think about Amazon, they're reporting very, very shortly, and AWS, that still seems to be the leader in the cloud space. What's the competitive advantage of Azure, and do you foresee in the medium to long term Azure potentially taking AWS's throne?
Well, I don't want to speak for future AWS growth, but we certainly have Azure growth outgrowing the rest of the hyperscaler growth over the next couple of years. And I think a competitive advantage is really in artificial intelligence. I think that Microsoft's ability to handle complex artificial intelligence workloads with the most famous private AI company that exists, and can handle their training, looking to handle their inference. They are training themselves today for future revenue in the next couple of years. It's not that we think that AWS had a first mover advantage. They remain the largest hyperscaler. That just is true. But in the next wave 2 of the hyperscaler growth story, we think it's pretty clear that Azure has an absolute differentiated story to tell on the artificial intelligence hyperscaler front.
All right, we will see how that story unfolds. Jackson Ader, thank you so much for your insights. Appreciate it.
Thank you.
Coming up, we're checking in on a few top trending tickers on the other side. Stay tuned, more market domination still to come. Wendy's delivering mixed third quarter results. Yahoo Finance's Brooke DePalma joins us now with the details. Brooke, stock is down about 6% and another U.S. same-store sales miss. So what's going on here?
Yeah, Wendy's is certainly not immune to the slowdown that we're seeing at large when it comes to the fast food category. They did post that mixed report, adjusted earnings per share coming in lower than Wall Street's expectations at 25 cents. Revenue coming in a bit higher at $566.74 million. But many investors really focusing in on that U.S. same-store sales grew just 0.2%. And this comes as it really had to compete with other fast food chains that we've really seen double down on value, like McDonald's as well as Yum Brands, Taco Bell. But they did note that we are seeing strong day parts like breakfast and late night, but that does imply some softness in their usual categories, lunch and dinner. And the company did trim its full year outlook due to a softer category environment. They do have this SpongeBob, this limited time offering that hopes will bring a bit of a boost to Q4. But once that promotion ends, Wall Street is uncertain of what that outlook could be for same-store sales growth.
You also spoke with the Shake Shack CEO, and they reported earnings, beat on both the top and bottom lines, a new loyalty program. Stock not doing much right now, it's flat, but what did the CEO have to tell you?
Yeah, this is an ongoing happening where we're seeing these fast casual segments really outperform the category, and we did see them beat expectations. Same Shack sales, like all same-store sales growth, grew 4.4% in the quarter, and he weighed in on that sweet spot that Shake Shack really sits in. Rob Lynch, CEO of Shake Shack, joined us this morning. Here's what he had to say. Take a listen.
The industry's been under some pressure to drive transactions. There's been a race to value. A lot of the big national players have, discounted a lot. And at Shake Shack, we've stayed true to delivering the highest quality premium products, and we've been able to keep our traffic positive despite the macro headwinds.
And it really is that sweet spot that he hopes to continue for Shake Shack to stick in, striking that balance between offering promotions on its core menu items like that burger and fries, as well as those hand-spun milkshakes that they pride themselves on with custard, but also offering those premium limited time offering. They had a truffle burger, obviously comes at a premium price. They're sticking around because people are splurging and they're buying it, and that's keeping customers going there. And so certainly sitting in this sweet spot yet again, outpacing and outgrowing the rest of the industry, what we're seeing here.
Yeah, and that stock has been a monster. What a run.
Yeah.
Thank you, Brooke. Moving on, now time for some of today's trending tickers, and you can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. Let's start here with Comcast, which is considering spinning off cable networks into a separate company. This includes cable properties, Bravo and CNBC. So that was the headline, Allie, spinning off its cable networks into a new company. They are commencing a study, apparently. Execs saying they are not talking about Peacock or broadcast networks. Of course, big picture, we know cable companies dealing with these subscriber losses. And you saw that again here, by the way. Q3, Comcast lost 365,000 cable TV customers.
Yeah, we're just seeing more and more consumers cut the cord here. So this isn't really that surprising. You're seeing all those cable properties on your screen. I mean, CNBC, MSNBC, USA Network, those are all things that are being considered in this spinoff. Now, Mike Cavanaugh, he's the president of Comcast, he said on the earnings call that the company really wants to play offense here. They think they have a solid balance sheet. They think they have strong assets to really create this new company, deliver it to shareholders. Analysts say that you could potentially sell that. And like you mentioned, we're at a time where more consumers are cutting the cord. We're seeing multiple companies like Paramount, Warner Brothers Discovery taking write-downs on their cable TV businesses because of this slowdown that we're seeing across the sector. So I'm not totally surprised to see this. It's very early innings. On the call, they said they wanted to come directly to Wall Street with this, be as transparent as possible, because they said they know how rumors out there start to take on a life of its own. And overall, Comcast did report solid earnings. We're seeing the stock up 3% right now, but it's this big overarching question across the entire industry when you think about the future of these companies that have multiple things under their umbrella. Where does that leave the future? What do you sell off? What do you focus on? For Comcast, it's going to be on their broadband user base along with streaming like Peacock.
Yeah, you said too, Al, I mean, report was solid. Q3 sales beat, profit beat, Summer Olympics, playing a role there for it.
Turning now to another trending ticker, Roku shares are sinking after fourth quarter guidance disappointed Wall Street. The company also saying it will stop reporting streaming households as a key metric. So again, guidance being the big thing there. They are going to be more focused on platform revenue. That this includes ad sales, revenue from distribution deals, and its over-the-top streaming service, the Roku channel. We did see that rise 15% year over year in the quarter. Now, prior to this release, shares had rallied about 30% over the past 3 months, but you're seeing some of those losses today down about 14% there. And really, this comes at a crucial time for the company. It underwent a lot of cost-cutting initiatives last year that included layoffs. They have been trying to bring down operating expenses and improve profits. They've committed to various monetization initiatives, including a partnership with the trade desk. And they do say that all of these tailwinds, it's going to help in the fourth quarter, and that political ad spend is going to be strong as well. But this is a company that investors really do punish if there's something amiss in this earnings report. And for this one, it was that guidance.
Yeah, and if you're not getting the number of households, and you're not getting average revenue per user either, so you're left with the metrics as an investor. You've got adjusted earnings, free cash flow, and streaming hours and platform revenue. Should mention they did offer a Q4 profit forecast. That missed consensus as well. And if you pull the stock chart back year to date, it's been plenty beat up. It's down about more than 30% at this point. All right, coming up, mortgage rates have increased for the 5th consecutive week. So where do buyers and sellers turn now? We'll discuss the latest housing hurdles on the other side when market domination returns.
Time for some more of today's trending tickers. Shares of Trump Media and Technology Group are plunging today. The stock extending its double-digit decline amid election uncertainty. You're seeing shares down about 12%. Now, this comes after we saw the stock experience its largest percent decline on Wednesday. Shares plunged around 22% yesterday. We're seeing those declines extend today. And since Tuesday, more than $3 billion has been shaved from the company's market cap. Although the stock is up around 130% from its September lows. So I guess if you want to look for some optimism there, if you're a shareholder. But look, DJT, it operates very much like a meme stock. We've seen this rise over the past few months as betting odds moved in favor of the former president winning the election. But, you know, it's really just taken on a life of its own at this point as we see this meme-like personification of shares. And I spoke with Steve Sosnick from Interactive Brokers. He told me, look, you're going to see these volatile swings to the upside, also to the downside. So something like this is to be expected, and there will be more volatility as we head closer and closer to that election day.
Yeah, and MarketWatch had an interesting column. They were citing JP Morgan data saying retail investors are exiting their positions. They've been selling shares of DJT aggressively. I mean, maybe to your point, you know, this one is so hyper volatile. So you hit a 52-week low on September 21st, and then you rallied hard, right? You hit this intraday high in late October, then we lost some momentum, so maybe some retail investors thinking they'll book profits for now.
Right, and look, if Trump loses the election, there's been some strategists that say this is a stock that could go down to zero. So you maybe want to sell ahead of that.
Although if he wins, then does it become his platform, eyeballs, marketers?
Exactly.
I don't know.
Yeah.
All right, Altria, that stock rising in today's trade. The company beating earnings estimates for the third quarter. This one going to cut at least $600 million of costs, it sounds like, over the next 5 years. Allie, maker of course, Marlboro cigarettes, says it's looking to increase speed, operational efficiency, maintained its outlook, importantly, for the year. Said the volume of cigarettes and cigars fell by about 8% in the quarter. Those sales of smokeless alternatives, those were rising.
Yeah, look, the smoke-free products, that needs to be the focus for these types of companies, big tobacco at large. But there is more local competition for those alternatives. There's a black market out there for vapes, and all of that could weigh on sales and operating income over the long term. So the pivot here for a company like Altria, it has to work since we are seeing cigarettes decline, the demand for that decline. Management did reaffirm EPS guidance between 2.5 and 4% for this year. So investors are going to be closely watching to see if they can hit that. And one thing that they're going to use to really accomplish that is, you know, the topic of the hour, artificial intelligence. They did say that they're going to be leaning on artificial intelligence and generative AI and automation to really help increase operational efficiencies. So I think it's a wait and see story for a company like this.
It was interesting because you heard rival Philip Morris also note that strong demand for its nicotine pouches. So we got a trend there. All right, moving on. Mortgage rates increasing for the 5th consecutive week, reaching their highest level since the beginning of August. For more on the current state of the housing market, let's welcome in Chen Zhao, Redfin senior economist. Chen, it is good to see you. So you know what? Let's use Josh Lipton as an example, Chen, because I am currently locked in a 30-year fix, 6.5, Chen. It's ugly. And I was told, you know what? There was absolutely 0 point in you refinancing Lipton until you get back to 5.5. When are we getting back to 5.5, Chen? What do you see ahead?
Well, it might be a little while yet. So you're right. Mortgage rates have really increased a lot over this last month. I think there's a few different factors that have really played a role here. So one is we've had stronger economic data, starting with the jobs report on October 4th. That means slower rate cuts from the Fed. In all likelihood, we'll get another read tomorrow morning on the labor market. But another really big factor is just the election. With the odds, changing these last couple of weeks, investors have become a lot more worried about President Trump's proposed tariff policies and how that might be inflationary for the economy. People are also worried about additional government spending, depending on who wins the White House and who wins, the House and the Senate. So mortgage rates have moved up a lot. So there's a lot of factors here. And the Fed is definitely, going to keep cutting, but mortgage rates may not, decline a lot more. So there's a lot of uncertainty here, I think.
And I want to pick up on one of those uncertainties that you mentioned, the election. Housing affordability has been a big topic of conversation on the campaign trail. So what would a Trump second term or the election of Harris mean for the market?
I think that there's a few different factors here, right? So you have to think about what, another Trump administration or a Harris administration means for mortgage rates. And those could look really different depending on which policies they choose to enact and, how negotiations around like the TCJA, tax cuts, how that pans out next year, for example. It also depends a lot on, whether Republicans or Democrats control the House and the Senate, right? So, bond market investors are really concerned with anything that stokes inflation or anything that really increases government debt by a lot. On the flip side, for the housing market, you also have to think about housing supply, right? So Vice President Harris has talked a lot about how she wants to build a lot more housing units, additional 3 million units. That would matter a lot for the housing market, but she also wants to implement a $25,000 first-time home buyer tax credit, which would stimulate demand. So there's a lot of these different factors at play. So it's hard to make a really concrete forecast right now, depending on who wins the election. But these are some of the factors that we would want to look at.
Jen, you mentioned supply. Why don't we have more supply? Why don't we have more inventory? I mean, is it regulatory challenges? Is it permitting? Is it builders can't find enough labor?
It really depends on if you're talking about existing supply or new home supply. So on the existing side, a lot of homeowners are really locked into very low mortgage rates, right? So a lot of folks refinanced or bought homes during the pandemic. So they have 3%, 4% mortgage rates, and they're very reluctant to give that up and trade up for a 6% or 7% mortgage rate right now. So that's, keeping a lot of existing supply off the market. But on the new home supply side, it's very hard for builders to build because they're also facing really high rates. And there's a lot of regulatory challenges, barriers to building new housing. And a lot of those factors are controlled at the local level. So it's actually hard for the federal government to play a role there. So these are all, things that keep inventory really low right now, which is one of the main challenges in housing.
So given these challenges, what type of buyer are we seeing in this type of market? And regionally, are there certain pockets of strength?
Sure, yeah. I mean, the people who are moving right now are really folks who really have to move. So even though inventory is really low and prices are really high and mortgage rates are really high, some people have to move because of life reasons. Maybe they got a new job or they had another baby. And so for these folks, it's not really, much of a choice. And yes, there are certain, pockets that are stronger or weaker. So we're seeing a lot of weakness right now in the Sun Belt. So for example, Texas and Florida are some of the states where the housing market is a little bit weaker. In the Northeast and more affordable places, you're seeing pockets of strength as people are looking for more affordability.
We're talking a lot about home buying. What about rents? Chen, what are the trends you're seeing there?
Yeah, the rental market is actually one of the brighter spots if you're thinking about affordability. So according to our data right now, rent levels are basically around the same as they were 2 years ago. So that's before you adjust for inflation. And, wages are still increasing about 4 or 5% year over year right now. That means that even though rents increased a lot during the pandemic, these last couple of years, we've started to chip away at some of the affordability issues in the rental market. And that is, kind of starkly different from what's going on in the housing market, where home prices are continuing to increase about 5% year over year. So the rental market is, I think, kind of a bright spot right now if you're thinking about affordability.
Chen, great to have you on the show today. Thanks so much for joining us.
Thank you.
And while wrapping up today's market domination, don't go anywhere. We've got you covered with all the earnings action following the closing bell, including the latest results from Apple, Amazon, and Intel. Stay tuned for market domination overtime.
That's the closing bell on Wall Street, and now it's market domination over time. I'm joined by Jared Blickery and Josh Schaefer to get you up to speed on the action from today's trade. Now let's see where the major averages ended up. You're seeing red across the screen. The tech-heavy Nasdaq, off 2.7%. The benchmark S&P down 1.8%, and the Dow shedding nearly 400 points here. So Jared, it seems like more trick than treat for the markets here on this Halloween day. If you take a look at sectors, utilities leading the way higher, so a bit of a defensive play there. No surprise that XLK, the tech sector, down more than 3%.
Yeah, and I've been watching the bond market recently, and yields been climbing high, and Bank of America or Goldman Sachs was out with an interesting announcement just saying that 4.3%, just a huge level in the 10-year, and arguably this huge rise we've seen in yields, maybe this is spilling over. Now, this is in our earnings story. We're sort of seeing some weakness in Meta and also Microsoft, but it could be that the bond market is also interfering. So you take, Jared,
I wanted to bring up on the interactive the Nasdaq 100 and kind of take a look under the hood to see which names are really driving stocks lower. I mean, Microsoft closing down more than 6%. That's very significant here.
Yeah, we were seeing some weakness yesterday, the chip stocks, and if I just switch this over to the semiconductors, look at that. NVIDIA down almost 5%, Broadcom about 4%, and here's over the last 2 days, you can see AMD down 13%, Intel down 6% as we wait for some of these earnings to come out. But here's a 2-day view on tech, on all the sectors. You can see XLK down 4.7%, only energy and utilities in the green, and that's also been kind of a theme that we've been seeing recently where we've seen energy and tech switch places. We've seen a lot of sector rotation, but not a whole lot of that today. The market seems to like utilities, but arguably kind of a defensive play.
Yeah, we'll see what happens too leading up to the election next week. I'm sure there's going to be more volatility. We were speaking to some strategists earlier in the show about how definitely in the short term, we're going to see more volatile action there.
You know what's really fascinating though is that we have not seen a lot of realized volatility. So everybody's expecting to see all this volatility with the election, but you take a look, and if we can go back to the Wi-Fi Interactive just briefly here. Here's the S&P 500. Now we had this big down day today. That really sticks out. So that's a negative candle, but we've just been camping out and kind of meandering around by these highs. And throughout the month of October, I don't think we had a single down day of greater than 1% until today. So I would say we were due for a little bit of volatility, and it's manifested to the downside. Is this something new? Is this a start of a new trend? Here's the 10-year T-note yield. Here's what I was looking at before. This big rise is of concern for risk markets in general because of the speed of the move. You take a look at a 3-year chart, you're not going to say, or you're going to say, well, that's not that big. But these things, these bets in the bond market, heavily leveraged, and when we go up 50 basis points, that's a big deal.
Love it, Jared. Thank you for that analysis. Now, I want to get to some breaking news. Amazon earnings just crossing the wire, and shares are higher on the back of a beat on both the top and bottom lines here. So both revenue and EPS coming in ahead of expectations. Operating income also ahead of expectations. Operating margins coming in at 11%. The estimate there was for 9.3%. Now, for AWS, the cloud component of the business, net sales hitting $27.45 billion. The estimate was around $27.5 billion. So roughly in line, a slight miss there. For fourth quarter guidance, they see net sales coming in between $181.5 billion to $188.5 billion. The estimate was for $186.36 billion. So we're seeing shares climb as much as 6% as that fourth quarter operating income. It was at the midpoint and topped estimates there. So it seems to be guidance once again driving this stock higher. And it's interesting because in the second quarter results, we saw guidance drive the stock lower. We're seeing the opposite is true today.
Yeah, what I'm really focusing in here on are the operating margins, there. So let's begin with the operating income, $17.41 billion, that's up 56% year over year, and that handily beats the estimate of $14.75 billion by about $3 billion. Operating margin, this has been a concern for investors, 11% versus 7.8% 1 year ago. The estimate was for 9.34%. So North America looks like that was 5.9%. That was a small beat. International, 3.6%. A much bigger beat than the estimated 1.23%. So at least on this one area, things are looking a little bit better. There are concerns about the consumer. So can they charge as much? Can they maintain their prices and also their margins here? And I think the answer is a little bit of those concerns have dissipated.
Right. Yeah, Jared, Amazon stock definitely seeing a nice pop here. Ali, you pointed to that guidance, and it seems like that seems to be the key thing perhaps driving this stock right now. Net sales in that range of 181 to 188. The one thing I'd point out there is that's quite a big range to some extent, right? We're talking about large numbers here in the hundreds of billions of dollars, but that is a $7 billion range. Wall Street's forecast falling kind of right in the middle of that. But other things to point out here that I think are standing out is just also another earnings beat from a big tech company, right? This is now every single one of the Mag 7 companies has had a earnings beat. So again, a reminder that that's not really necessarily what's been driving these stocks, but a trend we continue to see when we talk about S&P 500 earnings overall, to see beats from these Mag 7 companies, company after company after company, setting us up for 4:30 with Apple.
Right, and look, Amazon is this huge company, multiple components to the business. Andy Jassy in the earnings release, he noted that as we get into the holiday season, they're excited about what's in store for customers. They mentioned Prime Day, those big deals, obviously a huge component of the company. Also mentioned the NFL Black Friday game, Election Day coverage with Brian Williams on Prime Video. And we know Prime Video, it has really stood out to me as someone who covers the media space. They've heavily been investing in that business, investing in sports. They just rolled out ads on the platform. Advertising strength continued in the quarter. So just another name, like you said, with the tech giants.
Well, and the other thing I'd point out here too, remember yesterday a couple of these big tech stocks, I believe Microsoft was positive right after it reported before reversing down. We don't have a clear view looking at this release into what Amazon is planning to spend on AI, right? If we're talking about that being one of the key things right now that is perhaps weighing on some of these big tech stocks, there's not a clear capex read here on what they're spending on AI. That's usually something you get a little bit more detail once we get on that earnings call at 5 o'clock. But I think that's going to be another key part of this story, because it certainly seemed to be a big part of the story for its fellow big tech companies.
And we have another name that we're watching, that's Intel. Third quarter earnings just crossing. We're seeing shares surging up more than 10% on the back of this report. Now, third quarter revenue coming in ahead of estimates, $13.28 billion. The estimate was for just over $13 billion. We saw in third quarter adjusted loss per share of 46 cents versus the expected the 41 cents was a year over year prior. So kind of losses continue to accelerate. This is a company that we've seen the turnaround story be top of mind for investors. Intel CEO Pat Gelsinger saying that distinct but better together is the strategy here. So as we see this inline forecast during this overall rebuilding plan, it looks like a better than feared viewpoint from investors.
It was a low bar, and they've cleared that. They've stepped over it. Let's take a look. I'm going back to the fourth quarter forecast here, seeing revenue of 13.3 to 14.3 billion. Now that the estimate was just was at the low end of that range, so 13.63 billion, and then the low end of the range was 13.3. Again, the upper range was 14.3, so they beat that. Then they are seeing adjusted EPS of 12 cents versus the estimate of 6.3 cents. And they're seeing adjusted gross margin of 39.5%. Estimate was 38.7%. So you put it all together, and they're beating some of these metrics. And if I can go to the Wi-Fi Interactive, I'm just going to chart real quickly the year-to-date price action. Just a reminder, this is a company that's going through a tough turnaround, down 57% year-to-date. Here is the last 5 years, and you can see they have been plumbing new lows here. And on a max chart, they are basically back to territory where they were about 10 years ago. So this has been difficult, but they're trying to find a bottom right now. And is this it? Hard to say, but this is going to be maybe just that one little increment forward in that direction.
Yeah, once again, guidance, as they're seeing with all these tech companies, that's been very, very important for investors. I want to call out the data center and AI revenue beating expectations, $3.35 billion. The estimate there was for $3.1 billion. Now, Pat Gelsinger did say he intends to keep the company together. A big question, of course, moving forward is, what is this strategy? What is this go-forward strategy for this company? And be sure to tune into Yahoo Finance later, because we will be speaking with Pat Gelsinger, the Intel CEO. That interview will be airing tomorrow at 9 a.m. Eastern. Amazon announcing a third quarter beat on earnings and revenue. Joining us now to break down the report is Arun Sundaram, CFRA Research Senior Equity Analyst. So Arun, high level here, what's your take on this earnings report? It seems like overall strong and investors are approving.
Yeah, no, overall I thought it was a terrific report. You got the ingredients you needed for the stock to go up. One, you got the AWS beat, or AWS was in line, but most importantly, AWS growth accelerated to a little bit over the 19%. We needed to see that acceleration given that both Microsoft and Google saw accelerated growth. And then I think the real standout here is on the operating income line. We saw what was it? We saw about over $17.4 billion in operating income, and operating margins were 11%. That's the strongest operating margin going back, at least several years. And you really saw margin improvement in all three business segments. The North America business segment, which is mainly the retail business, saw margin improvement. The international business is now profitable, which is great. And even AWS, you saw margins in AWS accelerate to 38% from about 36% last quarter. So really, everything you really need for the stock to go up today.
Arun, there seemed to be some conversation, I know Microsoft pointed to this on their call, about spending on AI perhaps weighing on margins, right? It doesn't seem like we're seeing that, at least from this quarter with Amazon. I guess, why is that? How does the AI story sort of work with Amazon, where it might be different, maybe perhaps what they're spending on it, than it would be at other companies?
Yeah, great question. Yeah, all the hyperscalers are increasing their capex spend. Even this quarter for Amazon, it looks like they spent about $22 billion in capex this quarter, which is a pretty notable acceleration from Q2 and Q1. But yeah, you're right. When you're initially investing in AI and servers and chips, there's usually a margin headwind associated with that. I think what's unique with Amazon, there's a few unique things. One, Amazon's not solely reliant on chips from NVIDIA, for example. They also build and create their own AI chips that are more cost effective and of more value. So they may not be seeing the same type of capacity constraint issues that Microsoft is seeing at the moment. And then the other thing I would point out too is, Amazon has multiple levers to grow margins. So even in a given quarter, if in a given quarter AWS margins are down, then they can flex their e-commerce business and try to improve margins there. And we do believe that Amazon has significant margin potential in their retail business. It's still, the margins are still relatively low, about 5-ish% right now in that retail business, about 6% in that North America retail business. But I think over the next year or two, the margins will improve. There's a lot of efficiencies, I think, in that retail business. And lastly, I'll just point out, advertising. That's a very high margin business for Amazon, and advertising is growing faster than their core e-commerce business. And that bodes well for Amazon's overall margin profile.
So Arun, you sound very bullish on Amazon, but in your notes, you did say that you're cautious that growth for its profit and free cash flow may not be linear. What are the biggest concerns there, and what could those possible headwinds mean for some of that growth and the stock in the longer term?
Yeah. No, we thought expectations for Amazon are always really high, and this quarter in particular, there were some unique, I think, headwinds to margins. Number one, their business called Project Kuiper, which is their satellite business. It's essentially a competitor to Elon Musk's Starlink business. But they're just starting to launch satellites into the sky, for example, and there's production costs associated with that, and we thought that would dent margins in the near term. Also, all the money they're spending in data centers and chips, that's typically a margin headwind over the near term. So we just wanted to warn investors that you probably won't see that gradual linear increase in margins, but at least this quarter, margins were much better than we expected. Like I said, 11% operating margins, are quite strong, especially given that a few years ago, Amazon was posting a loss, for a few quarters. So they've gone a long way from becoming unprofitable to now 11% operating margins and over $17 billion in operating income.
Strong margin story here for Amazon. Again, the stock is up nearly 5% in after-hours trading. Arun, thank you so much for your thoughts and for joining us today, along with Josh Schaefer. Appreciate you, as always, joining us. Coming up, Intel shares jumping on the back of a strong revenue beat. We're joined by an analyst on the other side to break down the numbers. Stay tuned. More market domination overtime is coming up. Intel reporting third quarter earnings moments ago. The company beating revenue estimates, coming in at $13.28 billion. Q3 data center and AI revenue also coming in above expectations at $3.35 billion. For more, we're bringing in Patrick Moorhead, founder and CEO and chief analyst at More Insights and Strategy. So, Patrick, I mean, expectations were certainly low coming into this print, but we're seeing the stock up double digits after hours. What's your biggest takeaway here?
Biggest takeaway is solid operational performance with a solid guide. The street is definitely reacting to that $260 million beat on revenue. And while EPS is a little bit harder to get underneath because there were some impairment charges that went into non-GAAP EPS, gross margins, when you adjust for all that, is in the 40s. And, you know, the street was expecting a 3-cent loss on non-GAAP EPS, which turned into a 17 cent gain, depending on how you want to do the calculations. And I think any good news was good news for this stock that is trading well below book value.
And I'm reading in the release that those restructuring charges meaningfully impacted Q3 profitability as we took important steps towards our cost reduction goal. So what's the read-through there when you think about these restructuring charges, when you think about all the cost cutting that this company has been doing to get this business back on track? How should investors be looking at all of that in totality?
Yeah, so the company is still spending a lot on investing in go-forward profitable businesses, but they are taking the right steps to reduce overlaps. And you know, when you're a company that could do no wrong for 20 years and you get into a speed bump, you have to make some pretty drastic changes. And that's exactly what the company's doing. And for this quarter, right, they took about $15.9 billion in impairments. 3.1 made its way into non-GAAP EPS. But those who are looking for a long-term opportunity, there literally is no other way than going up. The number one factor that I look at is the 5 nodes in 4 years. So that's the ability for the company to manufacture not only its own chips more efficiently, but also to better compete with TSMC. And the 18A node, which is the turnaround node at a time when TSMC is raising prices and also coming under regulatory scrutiny, is all good for Intel. The data center and AI group number was up thanks to Xeon, not necessarily an AI GPU, which is coming in 25 or 26, but the best is really yet to come for this company and requires some patience and belief.
So how does this report set up the next phase of Intel, especially its positioning within the chip space? You mentioned some of those competitors, AMD, another one that I've been hearing about as well, taking some of that market share away from Intel.
Right. 2025 and the beginning of 26 is really going to be the ultimate proving ground for Intel. They're going to be on their latest node with their latest devices, and this latest node should be much higher performance at a much lower cost at scale. And then you're truly going to see the capabilities on the CPU side. And then also in 2025, Intel brings out a new data center AI GPU. Intel has a data center accelerator very similar to the ones that the hyperscalers are producing, but to compare side to side with AMD, we're going to have to wait for, again, till 2025. In a chip company, these turnarounds, they take 5 years, and we're almost into the 5th year here under Pat Gelsinger's leadership. And even though the stock has been battered and disrespected, it is setting the ground for the ultimate showdown with AMD and Intel in 2025 and the first half of 26.
You mentioned Pat Gelsinger, and there's been a lot of talk about this company and really if he's the right man for the job. Do you think this report, does it give you the confidence that he's doing the right things to get this company back on track?
It does give me confidence, and I think it should give investors confidence. I mean, the company can have no mistakes. The thing that I always get back to is, okay, is it the right strategy or the wrong strategy that Intel's on, which is fundamentally to keep manufacturing and design in the same place? I am absolutely a believer they must be in the same place. We looked back to AMD when it split off its manufacturing, which became Global Foundries. That was a nightmare for both companies, and it was too much, too early. And then if you're questioning Pat as the leader, well, who else, right? If you believe in the strategy, then who else coming in? And I think this earnings announcement will pull back any questions or discussions about how Pat is doing right now. Now he has to continue it quarter after quarter after quarter to keep this going. But I think this quarter and particularly the guide is a very good sign.
Patrick Moorhead, thank you so much. Appreciate your insights. And tune in tomorrow morning. Yahoo Finance Executive Editor Brian Sozzi will have an interview with Intel CEO Pat Gelsinger in the 9 o'clock hour. You won't want to miss it. Tech stocks dragging down the broader market, but with the results tonight, tomorrow could be a different story, especially as investors wait for the October jobs report ahead of the open on Friday. Joining us now is Kelsey Barrow, JP Morgan Asset Management Fixed Income Portfolio Manager. So Kelsey, let's start there on that jobs report. There's going to be a lot of noise, right, with the weather, the strikes. So how should investors really look at this report? Because it's probably not just all about that top line number.
That's right. So we have to take the number with a big grain of salt. If I look at the estimates out there, the range is abnormally wide. So you have the lowest estimate at minus 10K, and the highest estimate I've seen out there is 180,000 jobs for the month of October. So that's a massive range, right? And what people are trying to understand is, one, you have weather, we had 2 hurricanes, and then also the Boeing strike. The estimates are that's going to put downward pressure on payrolls to the tune of about 50 to 70K. So, okay, so what should we do with that? Well, what I would recommend is to actually, what we're focused on is to look at the backward revisions to September. Okay. So if we turn back to a month ago, the payrolls report was really a scene change in terms of the assessment of the labor market. It was a strong report that really made people question, is the labor market still cooling or is it actually inflecting higher? So what I'm looking to see is if that 254,000 jobs that was created last month, is that going to be revised down, and by how much? And that's going to be a really important signal, particularly because we know the October data is going to be so noisy.
Got it. So revisions key for tomorrow's jobs report. And now your base case, you still have a soft landing priced in. So what's the risk to that view? Let's say if the jobs number comes in hot, we've seen hotter GDP. I mean, to me, it feels like a no landing could potentially be on the horizon. How do you see that all playing out through the end of the year?
So the one question that I'm always trying to answer when I look at the labor market data, because this is the way the Fed looks at it, is the labor market an inflationary source for the economy or not? So if you think back to 21 and 22, there was a clear labor shortage. There was an imbalance between the demand for labor and the supply of available labor. Wages went up dramatically. And that was a source of inflation that the Fed was very concerned about. Now, when I look at the mosaic of labor market data now, I'm not seeing the labor market as a source of inflationary pressure anymore. So even though we've seen a strong jobs report last month and we have seen some volatility, I look at things like the employment cost index, which came out this week, or the job openings labor turnover survey, JOLTS, which also came out this week. And what it's indicating to me is I think that the labor market is still on a moderating trend, one where inflation will remain under control. And that's what allows the central banks to continue to cut rate, extend the cycle. And that's really where the idea of the soft landing comes from.
Got it. Now you specialize in fixed income. We have seen this steady rise in yields over the past month, the 10-year moving higher today. What do you attribute to that rise and what it is trying to tell us about the current market environment?
Well, it gets back to the last jobs report. I mean, that was really the first catalyst that caused yields to start moving materially higher. So if you think back to that time, the market was debating between if the Fed was going to cut 25 or 50. That was really the debate. And the view was you cut 50 because the risks to the labor market are rising, the unemployment rate is rising, and we need to protect against that downside risk. What's changed is really not the base case, but how investors are interpreting the tails. So that tail risk of recession and of materially weaker labor market, that's been priced out. And as a result, you've seen the 10-year yield move higher, and you've seen the market start to price in more gradual rate cuts. So the market is still pricing in rate cuts for this year and for next year, but to a terminal rate that's still above levels that we've seen over the last 20 years. So to a level around 3.5% to 4%.
Yeah, it's been a very interesting market, a lot of moving parts. We'll see what happens next week at the Fed, also the election. We didn't even get to that. So a lot happening. Kelsey, thank you so much for joining us. Appreciate it. Coming up, Apple's set to report their latest earnings results. We'll get you the numbers and analyst reaction on the other side.
Apple's fourth quarter results just now hitting the wire. Let's take a look at those numbers. So on the bottom line, diluted EPS 97 cents, but this is important. Diluted earnings per share was actually $1.64, up 12% year over year when excluding a one-time charge recognized during the fourth quarter. Remember what consensus was here, EPS of 160. Revenue, $94.9 billion, that's up 6%. That is a beat. The street was close to $94.36 billion. Gross margins clock in at 46.22%. The street was closer to 46.02%. Let's go down to the segments as well here. iPhone, $46.22 billion. That is a beat. Analysts were looking for $45.04 billion. As for services, $24.97 billion. The estimate on the street, $25.28. iPad, $6.95 billion. Mac, $7.74 billion. Wearables, home and accessories, $9.04 billion. And then Greater China, always in focus, $15.03 billion. The estimates I had seen called for $15.8 billion. I did have the chance to chat with Apple CFO Luca Maestri. Let me bring you those comments. I asked Luca, first of all, I was curious, why do you think iPhone customers right now are upgrading? I asked him. Is it because of Apple Intelligence? Or no, maybe the answer is much more simple. Maybe it's just there's a lot of relatively older models out there right now, and people are actually upgrading because those new models are attractive for the hardware, right? The processor, the battery, the camera. Luca Maestri telling Yahoo Finance, he thinks it is in fact all of the above. He says customers, we see they get excited by sure battery life, performance cameras, the hardware, but he says iPhone 16 does offer that, and now these new Apple Intelligence features as well. He's using them, he finds them useful, he finds them relevant. I also asked him about the rollout of Apple Intelligence. Remember, it is a gradual rollout, and I asked him whether you think as these features kind of gradually roll out here, could it be a strong iPhone cycle, but maybe it ends up being more back-end loaded. Maestri telling us, listen, it is bottom line, he told us that's difficult to predict. This is different than what we have done in the past. It's a broad set of features, new tech that's been rolling out in stages. He said the number of features now, of course, that are out, writing tools, summarization, then second rounds coming in December, he said, ChatGPT integration, and then more new features next year. It's another reason he argues you're going to see upgrades, you could see upgrades, but it could be a different kind of cycle, he said, than we have seen in the past. I want to touch on services as well. Remember that clocked in at $24.97 billion. He said 12% growth. He says we feel good about that. He reminded us that last year, so that's Q4 23, that was, he says, a very difficult compare. So he says very happy with the performance, all-time revenue records he said across most categories. And finally, China, big emphasis for Apple investors. It's a key end market, of course. China, he said, if you see the results in this quarter, the September quarter, flat year over year, and he said that is an improvement from earlier in the year. By segment, he said iPhone did well, services grew nicely. He said we're seeing a lot of people new to these products. He did remind us that macro not particularly strong in China. Right now, we can see the stock is down right now about 2%. We did not get guidance. Remember, that would come on the call. Apple is not providing formal guidance, but they have been providing very detailed color and commentary about what's ahead.
Yeah, we know how important guidance has been with all of these big tech players. I mean, I was a bit disappointed to see that the services revenue missed expectations there, because heading into this print, a lot of strategists had said that this is an area of growth for this company. It is the second biggest revenue driver behind the iPhone, but the iPhone sales, that was a big focus, right? Demand. Yep. We wanted to make sure that consistent demand with the iPhone 16 will carry out. Still early days for Apple Intelligence. We'll see if that's a boon in the future quarters, and I'm curious what the guidance is going to be on the call.
I think attention now goes, listen, what kind of color and commentary they say on this call now about that all-important holiday quarter. That's what you're listening for. Well, for more on Apple's fourth quarter, let's bring in D.A. Davidson's Managing Director, Gil Luria. Gil, great to have you on the show. The numbers just crossed the wire. I'm interested to get your instant analysis. Gil, what do you make of this print?
It's very important that they met and slightly exceeded expectations on iPhone. As you've been discussing, the Apple Intelligence features had yet to be released at the time the quarter ended. They've been starting to trickle out since. And expectations for iPhone have gone up considerably since Worldwide Developer Conference. So the fact that without those features, they've been able to start achieving the high growth expectations is very encouraging. And as the upgrade cycle happens, it will draw with it services revenue. So it'll be iPhone will accelerate first, and then it'll drag with it more services revenue.
Okay, so Apple Intelligence really driving this ecosystem there. So how much of a driver do you think it will be over the next year? Because as we were just discussing, still early days, we still have a lot to roll out here.
Yeah, so if Apple hasn't really grown iPhone sales for the last 3 years, expectations now are that it can actually grow at 5 to 10% for a variety of reasons, but really the important one is Apple Intelligence. I've started using it on the phone last couple of days, and the features are compelling. Being able to record a call and see the transcript immediately, seeing emails and being able to summarize them, respond and do the editing based on the generative AI on those responses. I have kids, I get these really long multi-page emails from the school. I was able to click on it, summarize it, respond, and then edit my response to be a little bit more friendly than I would have otherwise responded. And these are brand new tools that were integrated into my experience. So these tools are compelling, and as consumers start seeing them, they will encourage each other to upgrade their phones.
Gil, I want to drill into China for a bit as well. 15.03 billion. I don't know if that matches up with what you were looking for. I talked to Luca Maestri about that. He said, listen, results there flat year over year, which he said was an improvement from earlier in the year. One question I have, Gil, when Apple Intelligence gets turned on over there in China, how, if at all, do you think that could change its competitive position in that market?
China's the most competitive market in terms of the feature functionality of the other phones. And so it's especially important in that market that Apple has the most innovative feature functionality. The Chinese market is very much dependent on that for growth. The number itself is a relief. There were reports from various sources, as there often are, that Apple will disappoint in China. That didn't happen. And again, before any Apple Intelligence features. Once those are rolled out, Apple will have a little bit more tailwind in this market, which is, again, not only the most competitive, but also the most volatile in terms of the results for Apple.
Gil, we'll have the call coming up soon. Guidance will be provided on the call. What do you think investors need to see there?
Positive commentary about the next fiscal year, the holiday season, how they're going to promote the iPhone, how their carrier partners are going to promote it, the rate at which the Apple Intelligence features are coming out. That's really important because, again, this all goes back to, can the iPhone grow 5 to 10%? If it can, they will meet expectations, and that will drag revenue from all the other lines like wearables, like services. So that commentary about what they're doing to promote iPhone for next year, what rate they're going to be able to introduce new features will be critical.
Gil, I want to touch on margins as well. 46.22, that beats consensus, which was more like 46.02. So margins hanging in there, Gil, and certainly compare where they were a few years back. What do you make of that? What does that suggest to you?
That's another place where the iPhone sales really matter. The upside there is because they had iPhone sales, they've been able to keep the price points, keep the mix going up. As long as they can do that, the whole margin profile of the company will benefit, and they can increase margins with this product cycle. Again, that's why the iPhone's so critical.
Gil, you have a buy on this name. What would be on your wall of worry for Apple? What would be the risk to consider?
If they can't roll out these Apple Intelligence features in a timely way, if consumers don't have as positive experience as my early experience has been, then it's going to be harder to compel people to upgrade. Even if there is an aging phone base, even if they do promote it, to get that type of meaningful growth, 5 to 10% in iPhone, the features have to be compelling. People have to like using them. They can't deplete the battery. They have to work seamlessly. When they introduce the ChatGPT integration, that has to work really well. iPhone users have high expectations. They're not into experimenting. They want things to work the first time.
And Gil, if we take a look at after hours moves, we're down a little over 1% at this point, 1.5%. Stock is jumping around a bit. What do you think is driving shares to the downside? Is it that miss we saw in China and the miss we saw in services? In your view, what do you think investors wanted to see that they didn't in this print?
I think the shares are up about 15-20% since Worldwide Developer Conference in June. So expectations for iPhone growth were very high. And again, they slightly exceeded them, but some investors expected there to be a more meaningful contribution, even just from the hype around AI. And so that's maybe a slight disappointment. I would imagine if they give the positive enough commentary on the call, shares may reverse course by tomorrow.
Gail, always great to have you on the program. Thanks for joining us, sir.
Thank you.
Stick around. We're asking for a trend right on the other side. Palantir publishing what it calls a blueprint for the resurrection of the American industrial base. Company detailing how it thinks the government can transform the way it does business with the defense sector. And joining us now is the Chief Technology Officer and Executive Vice President of Palantir, Shyam Sankar. Shyam, good to see you.
Thanks for having me, Josh.
So this is this blueprint, right, for what you say could be the resurrection of the American industrial base. Walk us through this blueprint.
Well, I think it first starts with acknowledging that we're in this state of undeclared emergency. You know, we have North Korea firing off ballistic missiles, North Korean soldiers now in the front with Ukraine. We've had a pogrom in Israel. We have the Russians providing targeting information to the Houthis to hold 15% of world trade hostage. You know, what more would we have to see to actually kind of mobilize now? And so looking at that, you know, we have a couple weeks of weapons on hand for the China fight. We see that Ukraine expended 10 years of production in 10 weeks. And so are we ready? Are we doing everything? And when I look back at our history, how did we win World War II? How did we win the Cold War? We didn't have a defense industrial base. We had an American industrial base. 94% of spending on major weapon systems did not go to defense companies. It went to dual purpose companies. Chrysler made, in my lifetime, Chrysler made cars and missiles. Ford made satellites until 1990. General Mills, the cereal company, made artillery. The very laydown of our economy was so different. Every car, camera, and cereal box you bought enhanced our national security. And unfortunately, that's what China's doing to us. Only 30% of their defense company revenue even comes from the PLA. The rest comes from us buying cheap knickknacks on Amazon.
So is the way to fix this? Is it reimagining incentives, Sham? How do we fix it?
I think so. I think the talk track since the end of the Cold War is really that we consolidated our industrial base. We don't have enough competition amongst the industrial base. That may be true, certainly not my lived experience. I think the real problem is we gave up on competition within government. When we were building the ICBM program, it was the Navy, the Army, and the Air Force competing against each other to make the very best product. When we were building the submarine-launched ballistic missiles, we had 4 competing programs inside the Navy itself. Today, we would find that wasteful, duplicative. We grant these monopolies, which actually, if you really step back and squint at it, that looks like central planning and communism. We're saying there's just one approved way of doing this. And I think at a deep fundamental level, we believe in competition as a country. We believe in the innovation that comes from the free market. And what excites me, like what catalyzed me to really write this right now, is that the founders are back. I think the consequence of the Defense Last Supper in 1993, where we started this consolidation, is that we drove the innovators and the entrepreneurs out of the sector.
Which is such a big part of American defense history, those historic mavericks, innovators, right?
Exactly.
Yeah.
Like we think about it today as Northrop Grumman, but it was Leroy Grumman and Jack Northrop. It wasn't Northrop Grumman. It wasn't the institution. It was these people. It's folks like Palmer Luckey and Elon Musk. It is folks like Alex Karp. This is how we're going to resurrect the American industrial base.
So we have an election. Do you look at the candidate, Sham, and say one more than the other, Trump or Harris, it would be more open to reimagining the DoD in the way that you're kind of suggesting here?
Well, I think broadly, both sides, this is very much a bipartisan issue. People see the problems that we're facing here. But it really starts with leadership, which is, I think, maybe not something you'd expect a technologist to say. I don't think technology is going to magically save us here. When Admiral Rickover was building the nuclear navy, he was in that seat for 30 years. John Boyd was the father of the F-16. Who's the father of the F-35, the $2 trillion F-35 with 30% availability? It was designed by committee. It's run by committee. It's been 3 decades in design and development. There's a mechanism that was really working. And I think having become the world's superpower, we kind of turned our back on all the mechanisms that we actually used to win. And so we have a very clear blueprint that's actually based on our past. But I think one thing that's very clear is that we have to reindustrialize. And as a country, we have to reimagine how we're going to industrialize. And I see that, half of our business is about helping companies build cars, planes, trains, ships, bending atoms better with bits. And to do this, we have to give American workers superpowers. We can't compete symmetrically with China. At the dawn of World War II, we were the best at mass production. Today, our adversary is. So what is David's slingshot in doing this? Well, we are the world's best by a yawning margin at software. And so we have to use our AI advantage to bring automation and let's call it an Iron Man suit for American workers.
Is it sort of like bringing a Tesla manufacturing blueprint to
Exactly.
defense?
Tesla, SpaceX. I mean, we've been working with Panasonic Energy to make every battery in the Tesla Gigafactory in Reno, and they are giving their workers super. They're not using exquisite Japanese engineers. They're making every American as effective as an exquisite Japanese engineer.
I mentioned Trump and Harris, and a question about that, Sham, is, listen, neither candidate wants to address this country's fiscal challenges, which are serious. Bill could come due. At some point, you actually might have to get spending under control. Any concern that at some point there may be a haircut to defense spending and how that could ripple affect, Palantir and others?
Well, I don't think this is a spending problem. I think we are spending. We have plenty of money to go after this. It's how we're spending it that we need to really look at. I would say that with the caveat that we are actually spending at historic lows. We are spending, I think, roughly 2.7% of GDP. If we look back at what is the cost of ensuring our national security, which exists as a means of underwriting our economic prosperity and individual liberties, it is at a historic low. So I'm not saying it needs to go up. I'm just saying it would be good for because we see this big flagship number and it seems scary, but we have to actually understand it's relatively small.
Relative to GDP.
Yes.
Right. Let me ask you, I saw this interesting article, you saw it too in the Journal, this new DoD initiative. And the whole idea here, let's recruit top tech talent to join the reserves. You're part of that, it sounds like. Walk me through what's going on there, Shyam.
Well, I'd say in the past, we had a much closer relationship there between the civil and military sectors. When George Marshall was putting together the Marshall Plan, he really called up all of his friends who were the captains of industry. He had good advice around him. What I see and what I really learned from the early days of the Israel conflict, when they mobilized 360,000 reservists, when they went back into the IDF, they were horrified at the state of technology. And that is an exceptionally technical country. So that is an implicit self-critique, saying, wow, now that I'm 20 years more experienced than I was when I was a conscript, I've learned so much from industry. I've built these internet scale applications. I would do this differently. They modernized more in the 4 months afterwards than in the 10 years prior. And so we have this natural resource in this country in spades, not just in the software field, but in hardware manufacturing and in industrials and power. How do we bring that talent base? There is a people industrial based aspect of this and creating more fluidity for people to be able to serve in these capacities.
Did you think it sort of reflects this broader trend or shift? I mean, of technologists, tech entrepreneurs wanting to and embracing the U.S. military, wanting to work with the military? Is that a shift?
That is a I've been doing this for 20 years, and I'd say it's a
it wasn't always like
shift.
that, right?
It was the opposite of that. And I think that it's very clear now that people want to serve. They're not taking this for granted anymore. It is a sea change from what it was a decade.
Why is that, Shyam? What did change?
I think the world changed around us. Like there was a fair amount of, if you were going to psychoanalyze it, self-loathing in the country of what is going on here. But we see what's happening in Ukraine. We recognize that just because we were the global superpower, maybe the end of history didn't really happen, and everything that we're able to do as technologists, the economic freedom that we have is earned. It's not a birthright.
Let me ask you, I want to get you out of this, Shyam. So earnings are coming up. I know you got to be careful. I am interested, though, as you look ahead now, 2024, your stock has roared, right? As you look to 2025, what's next for Palantir? What excites you?
What really excites me is the continued adoption of AI across the U.S. commercial sector in particular, where people are rolling up their sleeves and getting busy implementing it. And what I see as a broad theme is you can kind of think of AI as there's two parts of it. There's the AI supply, the model side, and people are investing a lot in building these models. But if you take a step back and look at it, while the models are improving, both the closed models and the open models are getting more similar. So they're getting smarter, but more similar to each other. And if you look at the demand side, we've been uniquely positioned. This technology that we call the ontology, which other people are starting to notice now, is a prerequisite to being able to harness AI for economic value in the enterprise. We put into production a 78 AI agent model to automate insurance underwriting. And that's a very regulated field. The regulators have to sign off on that. It changes the process from taking 2 weeks to 3 hours. Now, the first order benefit people mostly think of, they're like, oh, wow, that's a significant labor savings. That's immaterial. Actually, yes, there is labor savings. The real savings, though, is the strategic dislocation in the market. If your competitors still take 2 weeks to underwrite risk and you're taking 3 hours, you're going to go eat the market.
Shyam, great discussion. Thank you for stopping by. Appreciate it.
Thank you, Josh.
All right, stick around. More Ask for a Trend right on the other side. Time now for what to watch Friday, November 1st. Starting off on the labor front, the October jobs report is out at 8:30 a.m. Eastern. Economists expecting non-farm payroll and hourly wage growth to slow down, with payrolls coming in at 105,000 and wages rising at 0.3%. The unemployment rate expected to hold steady at 4.1%. If non-farm payrolls come in at 105,000 consensus or worse, it will be the lowest total of monthly jobs added since December 2020. And taking a look at earnings, we're going to be seeing some reporting from the energy sector, including ExxonMobil, Chevron, and Enbridge. Exxon announcing results for the third quarter in the morning. Analysts expecting softer prices and weaker margins for the oil giant in Q3. Now shifting gears to autos, we're going to be getting monthly U.S. auto sales for October tomorrow. Those numbers are expected to increase to 15.8 million. The new data giving us more insight into the health of the auto industry, as high vehicle prices and borrowing costs are keeping some shoppers on the sidelines. That is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market moving stories affecting your wallet. Have a great night.